Welcome to MarketVelugu. You're watching the end of the dollar era, the first episode of a series named The Great Monetary Reset. They say the economy is strong, unemployment is low, markets are at record highs. But underneath, something doesn't add up. Consumer confidence is collapsing, debt is exploding, and inflation, the ghost everybody thought was gone, is finding its way back. Yet there is one chart they don't want you to see. Unemployment is rising again, and consumer confidence has collapsed to near record lows, a deadly combination for recession. Are we entering recession again? So the question now isn't if we are slowing down, but what kind of slowdown will this be? Every time the Fed tried to cool inflation with higher rates, growth slowed, but prices refused to fall. That's not recovery, that's stagnation. The COVID stimulus of 2020 sparked the first wave, prices jumped 8%. Now the new tariff dividend of 2025 is lighting the fuse for the next one. History calls this the third wave of inflation. In the 1970s, the first wave came after oil shocks when inflation hit double digits. The second, after the spending sprees in the pandemic when inflation rose to 8%. The third wave is forming now as faith in the dollar itself begins to fracture. 50 years later, the rhythm is repeating. Sticky inflation, slowing growth, rising debt. The textbook definition of stagflation. If history is any clue, we could see double-digit inflation by the end of the decade if policies stay unchanged. And when stagflation returns, the world's reserve currency will not walk away untouched. Every cycle ends the same way. Welcome to the end of the dollar era. With rising inflation and slowing growth, what does America's balance sheet actually look like? Federal debt is at a record $38 trillion. Add households, corporations, and states, it's over $100 trillion. I repeat, $100 trillion. That's America's total debt as of 2025. That's 4 times the size of the US economy. The government now pays more to finance yesterday than to defend tomorrow. Interest payments are at $1.2 trillion a year and growing. Defense spending $895 billion. Every 90 days of high rates adds $50 billion in interest. One entire NASA program gone. When standing still costs more than moving forward, something breaks. But why do markets still look unstoppable? Because we are not watching a boom. We are watching the afterglow of easy money. Wall Street feels unstoppable because it's living on borrowed money. The Buffett indicator that tracks the total US stock market's value against GDP is at 217%, the highest ever, officially in bubble territory. And the Shiller PE ratio sits near 38, a zone only seen twice before, 1929 and 2000. Investors call it innovation, history calls it leverage. Margin debt has crossed the 1 trillion mark, a record territory. Profits are rising modestly around 5%, while prices and valuations are climbing well into double digits. When prices rise 3 times faster than profits, that's not value, that's faith. Faith in liquidity, faith in policy, faith that this time is different. But markets don't crash because faith fades. They crash because math returns, and math always returns. Beneath record highs, another story unfolds, one the charts rarely show. The University of Michigan Consumer Sentiment Index has fallen to 50.3, among the lowest in history. Household debt is at $18.6 trillion, credit cards alone $1.23 trillion. Economists are calling it a soft landing, but for most families it feels like a silent recession. In Ohio and Michigan, people are borrowing to stay afloat while markets celebrate new highs. When confidence dies before the market does, the landing is never soft. You heard it before. The Fed is tightening to bring down inflation, but the real story is the opposite. Since 2022, the Fed has drained 1.6 trillion from its balance sheet, yet still holds 7.3 trillion, twice pre-COVID level. So far, the secured overnight financing rate has slipped below 4%. So far is not simply another interest rate, it is the benchmark rate under $400 trillion of notional financial contracts worldwide. And over the past 12 months, SOFR has collapsed 141 basis points from its December 2023 peak of 5.33%. This year, the Fed has cut 150 basis points in interest rate, while still signaling more rate cuts. So, liquidity is flooding again. Washington is helping ease the stress not through productivity but through short-term promises, new tariffs, new stimulus checks, and even a so-called tariff dividend. Recycled money dressed as prosperity is quietly creeping into the system once again. Tariffs don't create wealth, they shift it. Consumers pay more, inflation stays alive, and policymakers call it relief. Each rebate and dividend buys a few months of calm, while the foundation beneath the dollar erodes. This is stealth easing, both monetary and fiscal. Short-term comfort, long-term decay. In 1929, unemployment was 3.2%. Prosperity felt permanent. 2 years later, it tripled. Today, joblessness has inched from 3.4 to 4.3%. Small change, but rising. Tariff speculation and leverage have returned. Margin debt is above $1 trillion. The names have changed, the behaviors haven't. If history rhymes, what worse are we living now? This one chart the mainstream rarely shows, and it might be the biggest story of the decade. The US dollar moves in cycles, rising for years, then falling like a tide. Each turn reshapes global wealth. The last two down cycles after 1985 and 2002 ignited massive flows into commodities and emerging markets. Now the pattern returns. The Dixie index is resting near 99, but the trend points lower. If the third cycle is real, the world is rotating again, from paper wealth to hard value. When the world's currency turns, it doesn't just move markets, it moves civilizations. The Fed can print money, but it cannot print trust, and that's what is being lost. Across the world, nations are reducing dollar dependence, building new trade networks, settling in local currencies, setting the stage for a multipolar world where no single nation or currency dominates global trade. Markets don't announce their endings, they change tempo. And right now the tempo has changed. The end of the dollar era has already begun. Subscribe to MarketVelugu so you don't miss the next interesting episode on the emerging multipolar world, episode 2 of the Great Monetary Reset series by MarketVelugu. If you like this video, please like, share your feedback, and let me know in the comments below what topics interest you. Thanks for watching MarketVelugu Light on Markets. See you in the next episode.